Well, hello, this is Ken Himmler, and welcome to another broadcast of the Wiser Money Show. Today is Friday, April 1st, 2022. We got a good show with you. I'm going to go a little quick today because there's a lot of content to cover. We're going to cover unemployment, housing, interest rates, inflation, stock market, our famous Econ Map version 9, and then the new Secure Act 2.0. Love the government. Anyway, unemployment. I literally looked this morning and it went down to 3.8%, 6.3 million people unemployed, 202,000 new claims, but we're still at the lowest productivity output since the 1950s. If you didn't catch my show last week, I got a lot of comments on this one, which is the housing market. We're already seeing the breaks in the housing market because of the prices. They're increasing because of the supply chain. The only thing that's balancing them out right now is the interest rates and the supply chain. And the debt to income ratios will start to move that back. Interest rates have moved up to 4 to 5% on housing, and the supply chain is still broken. Steel, lumber, labor, gas, it's all still just a hot mess. Inflation and oil. Well, President Biden's plan to release 1 million barrels a day. Well, that makes sense, except when you look at what he's also doing. He's penalizing the oil producers in the U.S. if they have a federal permit to produce a certain amount. If they don't produce it, they're going to pay a penalty. Well, that's a problem because when he also releases $1 million a day of oil, it will push the prices down. When the prices come down, the oil producers can't break even to produce the amount of oil that we need. And their answer is, well, just use more sustainable energy. Well, listen, we are still a decade, if not 2 decades away from, air power, water power, nuclear power, electric power, all these things that are clean energy. So love to see how that plan works out. I don't think that the $1 million a day a barrel is a good idea, but you got to incentivize the oil producers so you don't have to keep using our reserves. Again, I think another big blunder by this government. Not to say that any government has never made blunders, but here it is. Incomes only went up 0.5%, but inflation went up 7.9%, 12-month trailing. And the big thing to talk about right now is phantom risk. We are at the highest point right now in phantom risk because now people are starting to see market volatility and they want to go into something they perceive as safe. Let me tell you, bank accounts, money markets, short-term bonds, it's not safe. It's why I titled this Phantom Risk is because you don't see it, right? It's like a phantom. You don't see it. It affects you, but you just don't see it. So what happens is you get your bank statement and you go kind of top from bottom. Oh, there's my name. There's my account balance. Oh, look at that. There's my charges. But you know what's interesting? Nowhere on that bank statement are they deducting for interest. So if you have $100,000 in a bank and next month you didn't spend any money, you still have $100,000. So you think to yourself, well, that's better than the stock market craziness and ups and downs and whatever the vernacular is that's being used. And so you say that's pretty safe, but it's not. And here's why it's not. I'm going to show you exactly. And now I've talked about this for the last, 8 to 12 weeks because of inflation. But I don't think really it's sinking in for a lot of people because I still get comments and questions through emails and chats about, should I go safe? Should I go safe? Let me show you. So if you got a bank account statement, as you see on your screen right there, you got $100,000 in your account, you see it's $100,000 at the end of the month. So you believe that you have $100,000. But here's what the real number is. If you have $100,000 and inflation was 7.9%, you lost $7,900 in purchasing power. Now, what do I mean by that? You can't go out and spend the same amount of money on utilities, insurance, gasoline, whatever else it is. So you don't really have $100,000. You have $92,100. But here's the big problem. Unlike the stock market, which when you see something that has gone down in value, if you use the word lost, it's not the right word. The word is it's down for right now because you only lose when you sell and you get out. But if it goes up and down, you don't lose anything until the day you sell. However, inflation is different. Inflation is an absolute loss that is not recoverable over time. Let me give you an example. There are things that are what I call variable, non-reoccurring, large non-reoccurring, and then there are reoccurring expenses. So if you keep your money in what we call the safe place, in the low rate of return investments, and 1 year from now you lose $7,900, you can't go back a year because you can't replace the time. It's unlike the stock market where you can just wait it out until it comes back. When you take an inflationary loss, it's in your face right then, right there. Now, the problem is the public. If you are not an economic studied person, you hear, oh, we have lower inflation. Or in certain remote situations, you might say, well, automobiles came down in price, so inflation didn't affect me. Yes, it did. And the reason is you only buy an automobile every 3 to 5 years. So the one time that you buy it doesn't necessarily mean it's going to offset the loss every year you take on keeping money in supposed low interest, supposed safe investments, but you still lose against inflation. Because again, an automobile is a variable, long, a large non-reoccurring expense. What also is housing. So if somebody said, well, I know we had 7.9% inflation, but that's including housing, and housing, if it crashes and it comes back 25%, that didn't affect me. Yes, it does, because you're not buying a new house every single year, right? Gas, same thing. It's a variable. It's only an expense that has an effect on retirement. Why is that? Because your income is not going up with inflation. Generally, if you have a job, they're going to give you some kind of inflationary increase every year. How about the things that really do affect you when you're retired? Utilities. These are non-variable expenses, meaning they do vary a little bit, but they're not these large every 3 to 5 years, and sometimes a house is every 10 to 20 years, right? So utilities affect you because when they increase a utility cost, even if inflation comes back, they don't decrease your utility charge. Insurance. When have you ever seen your insurance say, yeah, we had deflation this year, so we lowered your insurance cost? They don't. Why? Because they have to employ people, and they can't go to those people and say, we're going to reduce your annual salary. So insurance is a non-variable expense. Again, they don't reduce when there's deflation. Food, another one, right? They might have certain things that they decrease on. It might be milk or some things like that. But you want a box of cereal? It doesn't go backwards in price. You want meats? They generally go up and they generally don't drop, right? So these are things that don't really go backwards. Clothing, again, they don't go and you could find a sale, but categorically they don't go backwards. Here's another one that does not go backwards. TV, internet, cell phone service. These don't go backwards. Healthcare, they don't go backwards. Because there's deflation or inflation comes back, once doctors, hospitals, prescriptions, and long-term care facilities, they increase their prices, they don't go backwards. Subscriptions, same thing. Gyms, yoga, social members, golf clubs, they don't decrease their prices even if inflation comes back goes down, because they've already employed their people, they've already expended the dollars that they're charging you, so they don't go back. Netflix isn't going to come back and go, hey, we're going to, inflation went back down to 2%, so we're going to drop our $15 a month back down to $9 a month. It's not going to happen. So you have to understand how phantom risk really affects you, and that when you take an inflationary loss, you cannot recover from that. So let's look at now stock markets, okay? You see in front of you here now 40 years of history, 40 years. And you'll see there's some ebbs and tides, right? It goes up, it goes down. There's these little jockeyings, right? However, what is the one thing that you notice on this graph? Well, number one, time heals volatility. Whereas when you take a loss to inflation, you cannot have time heal that. Time is your enemy, it's not your friend. And if you look at what's actually happened over the last 40 years, from 1982 to 2022, the S&P 500 has gone up approximately 9.5%, beating inflation. However, you cannot plan your future based on averages. Why? Because what would happen if you picked one of those periods of time where the stock market went down and your retirement cash flow was based on that? That's a terrible plan. So during your accumulation stage, using averages works. It works. Okay, I'm not going to argue with that. Market volatility does not have risk if you don't need the money. But during your distribution stage, don't plan on using stock market averages. Try taking your cash flow. Don't try taking your cash flow from volatile markets, because it can create a system called reverse compounding. Meaning if you take something out of something that lost, you're going to use the opposite of the beauty of compound building. You're going to reverse compound, and that will lead to an accelerated loss. So you have to plan on using something called VMS. It's called volatility measurement segregation. It's a giant word for what I call the 3 buckets, right? If you've seen my 3 bucket strategy, you allocate a certain amount of assets to bucket 1, which has low volatility. Bucket 2 has a little higher volatility. Bucket 3 has the most volatility. And your cash flow from years 1 through 5 comes out of bucket 1, 5 through 10 out of bucket 2, allowing that crazy volatility in the stock market to not have to worry about it for 10 years. Thus, utilizing the time heals all strategy in the stock market. Well, let's jump over to where we are in the stock market. Well, so far, 12 months trailing, even with this bouncy back and forth, the S&P 500 is still up 12.7%. That compared to 7.9% inflation, we're still ahead of the game. Had you moved to what we call the supposed safe areas, money markets, CDs, and you're sitting on that money and you're earning 0.25%, you still lost a 7.5% or so against inflation. Well, how are we following this whole mess that happened with the supply shortage, the increase in inflation? Listen, this is going right on cue with the Roaring 20s. This is exactly what happened in the Roaring 20s. It's not exactly on the same timetable, but it's the same mental process that we're following through, and we're not through it yet. So when I bring up the timeline of opportunities, nothing has changed. I still anticipate the stock market going gangbusters until the first quarter of next year. As employment increases, productivity will hopefully increase. Inflation will increase to a certain period of time, assuming Biden stops messing around with this oil and the way that they're doing it, because it's just not going to work. And real estate is already starting to see a slide, and that's exactly what we're looking for. But again, if you looked at that circle of opportunity that I talked about before, I don't anticipate the circle of opportunity to buy real estate is going to happen until mid next year. Okay. However, if you've been watching this show for any period of time, you remember my prediction with the mortgages. It's starting to happen. Foreclosures are up almost 25% from a year before. So remember when I kept saying, as soon as people don't want to go back to work and their government aid runs out and the rent forbearance and the mortgage forbearance, they're going to start foreclosing. It's happening. It's happening right now. It's not at its critical stage, but we're starting to see that trend line happening. All right, big changes with the government. Secure Act 2.0. We have RMD changes, age 73. Okay, so let me go backwards. Slow down here. Secure Act was 1.0, was passed in January of 2020, and they increased the RMD age, that's the required minimum distribution age, from 70.5 to 72. I told everybody, put on your brakes, do not do your RMDs this year if you are under 75. Now we are going to start doing RMDs. Why? Because the law has passed both the House and the Senate, just waiting for Biden's signature. But basically, here's what's going to happen. The age 73 will not change until next year. We didn't want to make RMDs this year if they changed it effective this year, because then you would have taken money out and you couldn't have replaced it, but you had to pay tax on something you didn't need to take it out. So 2022, it's still age 72. Next year, it jumps to age 73. In 2030, it jumps to age 74, and in 2033, it jumps to age 75, okay? This is, in part of this Secure Act 2.0, it's also going to eliminate some of the barriers to lifetime annuities, what we call QLACs. But this is going to be balanced out. They're trying to get a lot of this stuff through before the midterm elections happen. And part of that is Biden's tax proposals. Now, you remember I said At the end of last year, when the Build Back Better America bill got killed, I said they're going to find a different way to do it. So what they're trying to do now is they're trying to push this through the budget. So the spend isn't there, meaning they're not allocating where to spend the money. They're just trying to get these tax changes pushed through the budgetary process. So here's what it is. An increased tax on personal rates. It's going to go up to 39% for couples with more than $450,000. Now, let me go back to my statements when the election happened. And I said, you remember Biden's promise? For somebody that wasn't earning more than $450,000, and I said that the key word in there is earning. Now, there's a difference to me between I go out and I find a job for $450,000, which would be pretty nice, but if I can't find a job. However, in that election, they never clarified what does earning really mean. Well, let me explain that. But before I do that, for those of you that have watched some of the broadcasts that I've done on amicable divorces, where you're married under the eyes of your religious God that you believe in, but you don't get a marriage certificate. So you're religiously enjoined, but you're not legally enjoined. Well, here's what happens. In many cases, you can get a lot better tax outcome. So the top bracket happens for those of you that are at $450,000 married filing jointly. However, if you're a single filer, you can each earn $400,000. So you remember me talking about the marriage penalty. Well, if you're married, you only get $450,000, but if you're single, each of you get $400,000, increasing the limit before you get to the high tax bracket of $800,000. So I've talked about, if you have a business sale, a big real estate sale, a big stock sale, consider changing your legal status and getting an amicable divorce. Doesn't mean you move out. It means you still share everything, but you're not legally married. Because remember that $450,000 that Biden talked about, it includes everything. So if you sell stock in a given year, it could include your capital gains, stocks, options, real estate sales. Consider that if you've got rental property, a business building, any of those things, it can hit you. And under the new Secure Act, earning more than that $450,000 also includes inheriting a retirement plan under the 10-year rule. So those of you that thought, well, that's not bad, I don't earn more than $450,000. It could be event driven. It's not whether you have a W-2 of more than $450,000. It's whether you have more than $450,000 of taxable income. Now, part of the other tax proposal is no step up in basis. This would be horrible, I think, for our entire real estate community. It would be just devastating. This is where when we die, we can't pass something on to the heirs with a new value. They go back to what we bought it for and they pay tax on it when they inherit it. Another one of Biden's tax proposals reduced the estate tax exemption from the current $11.2 million down to $5.7 million. Right now, instead of waiting until 2026 when it does come back. Now, those of you that followed my advice and you gifted away a large sum of money last year, smart move, because we got out of that change because we did it last year when the exemption was still $11.7 million. So even if they bring the exemption back this year to $5.7 million, you got that money out of your state last year at $11.2. This is a big push before the midterms because remember, if the Democrats lose the House and the Senate, there's no chance these proposals are going to get through. They're already having a hard time now with some pushback from the Dems from West Virginia and Arizona. So actions to take now. I'm going to pull these up here, but I just want to listen. I think if you asked me what my two biggest things are, don't go to cash. Do not. When they're talking about recession, that's fine. There's a lot of money made in stocks and recessions. Doesn't mean that it hurts the stock market. It just means that certain industries, travel, could be real estate, could be certain supplies with real estate, doesn't mean that we're going to lose money. Just like with the pandemic, it just means things will shift. We just have to anticipate that shift. That's why you listen to the show, and that's why you might be a client of ours. We are trying to navigate the storm. So we are the captains of the ship. Our job is to look at all the different weather reports, all the different GPSs, and make the best possible route that we can from all the information that we have. So at this point, I'd say there's two things. One is don't go to cash. Please don't go to cash. You're going to get buried against inflation. And number two, do your tax planning now. I'm telling you that somehow, some way, they're going to finagle this in and hurt us all tax-wise, which is why we were so hot and heavy in this last year. So with that in mind, we're going to wrap up today's show. If you're not a subscriber to Wiser Retire, all you got to do is YouTube or Google, just say Wiser Retire on YouTube. And Wiser Retire is a brand that we set up mainly if you're in the accumulation stage. But if you are in the distribution phase, then you're still good to go on staying as a subscriber on the H&H Retirement Design. Now, here's a real quick thing. We are going to start rebranding the H&H Retirement Design and Management. It is soon to be the H&H Financial Center. And we are going to pull in all of our different brands. And if you don't know those different brands, we have Integrated Wealth Management, which is a load and no load insurance agency. We have H&H Tax and Business Advisors, which does tax returns, tax planning, entity and document, legal document drafting. We have Wiser Retire, which is really a financial planning do-it-yourself system for those of people that are in the accumulation phase. We also have Certified Advisors Network, which is a training platform for advisors, CPAs, and lawyers. Okay, so we're going to bring all those up because as we expand all the services and offerings, it's getting a little confusing. So we're going to bring all those brands up into the H&H Financial Center brand. So you may see that brand change on YouTube, but that's why we're doing it. Hey, with that in mind, if you got any other questions, give us a call, 844-702-1040. Have a great weekend.